G'day everyone, this is Jackson Milan, the Wealth Mentor, co-founder and CEO of Aureus Financial.
Sam Panetta, COO and co-founder of Aureus Financial.
And welcome to our first Ask Aureus Anything question and answer live event.
Like they said, I am hearing a lot about the pros and cons of having a P&I loan or an IO loan. How do I choose the right option for me? All right, so P&I is principal and interest. IO is interest only. So to explain the difference between the two, when you have a principal and interest loan, every month when you make your repayment, you're paying back the amount of interest that's been charged to you that month, plus a little bit of principal as well. So you're slowly, every single month, you're chipping away and you're paying the loan back. Interest only lending, on the other hand, means that you aren't paying any of the principal off, you're only paying the interest bill every month. All right, so it's pros and cons. For the principal and interest loans, a couple of pros is that you're actually paying the loan off every month. So at the start of the year, and at the end of the year, the loan is going to be significantly smaller. Principal and interest rates are typically a lot cheaper than interest-only interest rates. Cons, your repayments are bigger. So if you're paying the interest bill every month plus some principal as well, then your repayments are going to be larger than if they were interest-only. And looking at the interest-only portion, some of the pros, the repayments are lower, so your cash flow's heaps better. You need to think for, let's say, an investor who's bought an investment property, they've got a 5-year interest-only period, they're making the minimum repayments on that mortgage for 5 years, but their rent covers their interest repayments. They're essentially holding that asset for very little costs. Right, that's one of the pros. Some of the cons is it's typically more expensive than principal and interest lending. And after say you've got a 5-year interest only period, if you've only paid the interest off after those whole 5 years, then your loan wouldn't have changed. If you took out a $500,000 home loan with a 5-year interest only period, if you haven't put any extra into that home loan, after the end of the 5 years, you're still going to have a $500,000 home loan.
Yeah, there's a big strategy element to it as well, isn't there, Sam? I think that flexibility for the interest only is more so for the investors who are buying an investment property. And I guess one of the key things is that if you are very dedicated in terms of your repayments, the interest only minimises your commitment. And if you put money into, say, an offset account, that it can still be working for you, achieving the same effect of a principal interest loan, but that money's yours, so you could redraw that and potentially use that as a deposit on the next property, as an example.
Yeah, correct. And that's what I do. So all my loans are interest only. Not that I don't save money every month. You have a surplus every month that you save, and then I put that money into an offset account. You save up to buy the next property. For someone who's got no discipline with saving,
Don't do it.
that's a pretty bad strategy, because you're not going to save anything, and then after the end of the 5 years, you're going to be still stuck where you are. In saying that, on the flip side, let's say you've got a homeowner, first home buyer who's bought their first home, they've taken out a loan at 80% of the value of the property. They can get a principal and interest loan, get some really, really good rates. And if they're a pretty simple sort of couple, right? So not too much complexity in their finances, they can just concentrate on paying that cheap interest rate and smashing the home loan out. So I don't think there's a right or wrong answer. I think it really comes down to the individual, what the individual is trying to achieve, and whatever strategy they're using to achieve their goals.
Yeah, look, the principal interest is a good forced savings that you're chipping away at it, and we always say that for a client to really consider the interest only, they have to be a little bit more sophisticated. They've got to be dedicated and have a proven track history of savings. And we generally say that they have to have the right budgeting structure, so there's no temptation to overspend, because these days it's just too easy to tap and go and money's gone. And also they should have a wealth coach or a strategic advisor supporting them, using, say, a piece of software that helps hold them accountable. Because without that kind of forced savings, think about it this way. It's an analogy I like to use. Why is it that so many business owners are behind on their tax bill?
Do you want me to answer it?
Yeah.
Because they're not putting the money away that they need to, they're not saving the cash that they eventually need to give to the taxman.
Exactly
They,
right.
they don't understand what's theirs to keep and what needs to go back to
Exactly right.
Mr. ATO.
So think about it, if the government just turned around tomorrow and said, oh, we're going to increase the tax rate by 10%, as an employee, you'd probably bitch and moan about it, but you just pull up your socks and move on with your life. There's nothing you can do. As a business owner, because you are paying by instalments, and those instalments can sometimes have wide frequency between them, you're probably going to get, for a lot of people, you're probably going to get into more strife with the ATO. So it's a similar way to look at it. Do you want a forced savings where it holds you accountable to making sure you have to have those commitments in regular and ongoing amounts? Or do you want the flexibility in order to execute a particular strategy, whether it be continuing to accumulate investment properties or having cash available? So, yeah.
Perfect.
Cool.